See, I think one learning for all of us is that good news and good prices really come together. So only when the news is bad, you get better prices. And we have seen so many cycles, in market, and especially last 2 years we have seen two cycles now, COVID period and now this Russia-Ukraine war issue. Uh, I think rather than just focusing on the index, I think sometimes the index is misleading. I think you should be more goal-oriented and goal-focused. So anybody who's been disciplined has done better than somebody who's tried to time the market. Always been the case. Uh, and I think right now what market has done is that it was when it was falling. I think it looked a little exaggerated, and now it's going up. Obviously, the cycles have really shortened. So I think you should, for retail investors, I think you should continue with the monthly plan you have. I think do not deviate. Uh, Anything where if your goal is approaching and let's say 3 6 months away, it may not be a bad idea to start taking maybe something off the table. But if the goal is some time away and it's more long term, I think you should continue. The monthly allocation can be through SIPs and funds, or even direct equity and stocks. Secondly, be a little more. The level of research has to go up. The level of discipline has to go up. While the index is still at 17,800, Sensex is back at 60,000 now as we speak. There are a lot of pockets where the correction is still pretty significant. So let's say, for example, a lot of the IT stocks which were commanding very unreasonable valuations 6 months back, we were paying 50 60 p multiples. I think some of them are pretty reasonable. Some of the large cap IT names are still 25 30% down. Let's say, without giving any recommendations, for illustration, let's say Tech Mahindra is 15 times earnings right now. So is HCL Tech. Similarly, some of the private sector banks are still available at reasonable valuations, around 2 2.5 book value. Some of them used to trade at 4 5 book values. Some of the pharma names like APIs and CRAMS have corrected almost 25 30% from their high. So if you are a direct equity investor and you're a non-MF investor, this is the time to actually go level two and track business earnings over and business performance over price performance. I think that's where you'll have the biggest hedge. Secondly, do not overpay. I think one learning is that don't chase the latest fad. In the market. I think if you don't overpay and you track earnings better, I think that's the best hedge for volatility. More balanced approach is needed. I think we are not out of the woods yet. The interest rate hikes haven't stopped yet. The market thinks central bank is going to pause. We don't know right now. In terms of, we also don't know whether inflation will again raise its ugly head, right? So be a little more balanced. I think this is also may not be a bad time to look at some fixed income. My 18 years in market, whenever I've seen 10-year bond at 7.5 8%, or US yields above 3%, even the fixed income returns for next 3 years have been pretty lucrative, adjusted for indexation, of course. So I think you should have a staggered approach to investing. I think that is a given. Also, you keep some powder dry in case you do get opportunities, and if you can up the level of research, there are opportunities, as I said, in healthcare, in IT, in some of the financials, as I said. Build it gradually and have a slightly more longer term outlook. Do not get swayed by 5 10% moves here and there. Also, anything which is just fallen doesn't make it cheap. So do not look just at price correction alone. It's happened with some of the new age companies. You might suddenly think that it's just because it has fallen, it's cheap. So I think, as I said, the best hedge is look for earnings growth wherever there is earning growth, where the valuations are more reasonable. Have a process in place and keep some powder dry, because what happens is that cash and courage do not come together. Strictly talking of startups, let's say, which have got listed, I think if that is the focus areas, I think, see, it's a very high risk, high reward game, and I think you should, as I've said this earlier, you should play this game the way VCs and angel investors do. They create a portfolio of 20 30 ideas, and they are willing to have an 80 90% failure rate, because whatever then does well picks up for the rest of the game. So I think I would personally not. I say I'm an old school guy, still focuses on cash flows and earnings. But let's say you want to take some exposure, a small exposure. You can create a concept bucket where you put some of these new. Within this also, you should have companies where the glide path to profitability is more
Yes, yes.
visible. So I think gaming, for example, fintech, for example, even some of these direct to consumer names, without getting into the specific names, some of the logistic companies, new age companies, I find I probably next probably 2 years you will see business models pivoting and probably a glide path to profitability. But create a basket, create a portfolio of, do not just bet heavily because the stock has fallen 50-60% from the IPO. I think that's dangerous, because sometimes the terminal value could be zero in some of these new age businesses. We don't know right now. So I would in general, for conservative investors, I think it's an avoid. There are better opportunities for investors who are more savvy and aggressive. Maybe a small portion, and that too well diversified. Risk management is paramount, right? If you manage risk well, and a large part of the risk is the concentration you take in a lot of these businesses. I think the returns will follow, and be, as I said, be prepared. I mean, even if your hit rate is 10-15%, I think you should be fine. There are three key risks here. One is the geopolitical risk. If China Taiwan was to happen, or there's further escalation in Russia Ukraine. I think that's the key risk to watch out for, because till now the supply shocks haven't been fully resolved. In fact, we are now seeing aftermaths of power crisis in China, some second order impacts coming. So that's one risk. That's why I'm saying inflation should not be ridden off, that everything is. So I think that's one, and linked to that is inflation, because supply shocks is what will lead to inflation. That's a key risk to watch out for. The second risk is the quantitative tightening. Mind you, the Fed has only raised rates. They've only tightened zero point 0.1 trillion. They expanded the balance sheet to 9 trillion, and none of us has seen contraction of balance sheet of it. This is new to us. We have seen rate hikes. We have not seen a 1 trillion, $2 trillion contraction in balance sheet. I think that will be something we will probably experience for the first time in the market. I think liquidity is something we need to be a little watchful of. And third, as I said, focus on your balance sheet, and more than on a lot of, there's too much noise in the market, on inflation, yield curve inversion. I think if you keep the basics right, do not get too carried away, both ways, both positive and negative news flows.